Hi, I'm Pattu from freefincal. Today, let's take a look at some frequently asked questions on index investing. Let's not talk about what is an index fund and so on. I think you know what that is. But let's start with who should choose passive investing. Now, anybody who desires a simple, effective, low maintenance portfolio that does not require too much of work in selecting funds, reviewing performance, and so on, should choose a passive portfolio. Now, the big problem with fund selection is it is heavily dependent on past performance. Now, it's very easy to choose an actively performing fund that has done well in the past, but there is no guarantee that it's going to do well in future. And anybody who has done mutual fund investing for about 10 years will tell you that things go up and down. Today there will be one fund on the top, after 2 years another fund will be on the top, and so on and so on. It will be like a cyclic kind of situation, and it's very easy to get caught up in this, but those who appreciate this will understand the benefits of passive investing. Unfortunately, such a wisdom comes only later, and also with the help of some data support that includes me as well. Now, the point I'm very particular about is that many passive investors or passive investing advocates have a very holier than thou attitude. They keep talking about why passive funds will beat all the active funds, why expenses are more important, and so on. All that is fine. I don't disagree with all that. But it's important to understand that in personal finance, discipline and consistency can easily gain victory, even if the investment choice made is not optimal. Even with suboptimal choices, discipline and consistency is more important. So I think it shouldn't make such a big deal about expenses and such a big deal about index investing being the only victor. I don't think so. I think there will be a situation where many active funds will beat index funds. Then there will be a cyclic situation. There will be up, there will be a downs. That's going to happen. We have still not seen that much of history in India, but I'm fairly certain that that's going to happen. And up to early 2018 or so, it was very difficult to see that passive funds were doing well. After that, only passive funds started emerging as victorious. So this increase in AUM, increase in interest in passive fund, as I have said many times, is in my opinion a fad, and that can go down. So I'm not saying passive investing is wrong. I'm saying the interest in passive investing is a fad. There's a difference. Now, another question is, India is a developing country, so people say that it should be easy to beat the market. If you look carefully, no. Whether it is large cap, mid cap, or even small cap, that has not been the case. Generally only about 50% of the fund managers are able to beat the category. In the case of small caps, yes, but then the small cap index is very easy to beat. If you have a slightly difficult index like Nifty Next 50 or Nifty Mid Cap, then even there the small cap fund managers are struggling. Now, is the emergence of passive funds not a recent phenomena after the market imbalance? So, since early 2008, what happened was, until at least the March 2020 crash, the top few stocks of the Nifty or the Sensex moved up, the rest of the market moved down. So, as a result, the underperformance of the active funds became very prominent. But if you look carefully, if you look at rolling returns, the fact that active funds in most category only 50% of them outperform comes out to be true, even if you look at a period before that, and I have shown that in previous videos as well. Index funds are ETFs. Please don't choose ETFs for investing. ETFs are meant for trading. You trade small amounts in an ETF which has got reasonable liquidity, and you should understand how to do the trading. But for investing, please avoid ETFs. And as I have shown before, just because an ETF has got lower expense ratio does not mean it's going to give you better returns. What matters is the price at which you buy and the price at which you sell, and that those fluctuations can and have resulted in lower returns. So how to choose an index fund? I think you should have a very simple thumb rule. Don't go by smallest expense ratio because it will not be permanent. It is just a way to get AUM. Today, one mutual fund AMC will say we are the low, we offer the lowest expense ratio. Once the AUM comes, they will hike it up. Now, choose a AUM fund with AUM of about 1,000 crores or more. Because if lower AUM will result in huge tracking errors. Higher AUM can also result in tracking errors, but I think we have not reached that point yet in the passive investing journey. Then please don't worry too much about tracking errors, because tracking error, first of all, it's difficult to find. That's why we have a monthly screener which we publish tracking errors, as well as the return difference between the index fund and the index. That return difference is the actual measurement of tracking error, because as Siva showed in Awesome Ideas of Wealth, if you have a constant expense ratio and you remove the expense ratio daily from the NAV, the tracking error will not be affected. So the tracking error you must measure in terms of the return difference. Then something with a reasonably low expense ratio, reasonably high AUM, reasonably low tracking error, just buy it. That's all. Don't waste too much time looking for the best funds. That's just going to be waste of time. What is the main source of tracking error? From whatever I have seen, the main source in an open-ended fund, and all index funds are open-ended, is the inflow and outflow of AUM. That is what causes difficulties for the fund manager to track. The other factors like dividends, corporate actions, all those things, and weights, daily fluctuations in weights, all those things can be algorithmically handled. But inflow and outflow is a big problem, because that's something that depends on the market. Because suddenly, if there is a big amount of inflow into the fund, you have to buy stocks. So the top few stocks of Nifty you can buy, but the bottom stocks of Nifty Next 50 or Nifty 100, for example, if you want to buy in large quantities or sell in large quantities, there will be an impact cost. That is the bid price and the sell price will differ. Those kind of things will cannot be helped, and no algorithm can sort that out, and therefore the tracking error can come. And so that's inflow and outflow, in my opinion, is the biggest source of tracking error. And I have shown that in India the market is not very liquid. Beyond the top 100 stocks, the tracking error becomes very high. That includes S&P 500 when we are investing from here, as well as Nasdaq 100, the ETF, as well as the fund of fund. Sensex or Nifty, which is better, doesn't matter. Both of them are essentially the same, because both of them are market capitalization weighted. Nifty or Nifty 100, which offers better diversification. You can buy Nifty 100, Nifty 50, Nifty 100, Nifty 200, 500, 750. Whatever you buy, returns will more or less be the same. What will happen is, more the number of stocks, more will be the tracking error, higher will be the expense ratio, and you will you're going to lose out on returns. So keep it simple and stick to Nifty 50 or Sensex for proper large cap investment. What about Nifty Next 50? Now, Nifty Next 50, you can invest in Nifty Next 50, but please recognize it's a very volatile index, and it can underperform the Nifty 50 for significant amounts of time. It has done so in the past, and it is doing so currently as we speak. Also, the volatility of Nifty Next 50 has relatively reduced since what it was in 2008. It has come down. So this means that returns will also come down. So you don't look at too much in the past performance and expect those kind of returns for Nifty Next 50. Should I invest in mid cap and small cap index funds for better diversification? Please don't. All you will get is higher tracking error and higher expense ratio. The impact costs will be very high in the mid cap and small cap segments. Please don't waste your money in such index funds. Can I invest in smart beta or factor based indices? Now, the problem with this is, what happens is, there is an active selection component in factor based indices. Instead of using market capitalization, you are using things like alpha, momentum, quality, value, low volatility, and so on. All that is fine, but as pointed out again by Siva, repeatedly in Awesome Ideas of Wealth, there is a what happens is, these index curators provide a very rosy picture of these factor based indices, because they have done backtests, but there is a conflict of interest in these backtests, and they only show backtests that work. So nothing will work all the time, that much you must appreciate. And we have seen that in the case of 200 Nifty 200 momentum index and so on. Can I buy an index fund in the NFO stage? Please don't buy anything in the NFO stage unless it is something so special, and that's almost never going to happen. The AUM is unknown, the tracking error is unknown. Please don't buy it. Can I invest in 2 Nifty 50 and 2 Nifty Next 50 index funds if my portfolio is large? You can. That's up to you. Some people are comfortable with 1 crore or 10 crore in a single mutual fund. Some people say I will not put more than 10 lakhs in a single fund. So it's up to you. So if you have any more questions on passive investing, please comment below.